Have you noticed something strange happening in the American housing market lately? Homes are sitting unsold for months. Young buyers are giving up on the dream of ownership. And now banks and policymakers are floating ideas that sound almost unbelievable. 50-year home loans and mortgages without traditional credit scores. At first glance, this might sound like great news. Smaller monthly payments, easier approvals, and millions more people finally able to buy homes. But what if these changes are actually warning signs that the housing market is under serious pressure? What if the system is becoming so expensive that lenders now need to stretch loans across half a century just to keep the market alive? Today, we're breaking down exactly what 50-year mortgages and no credit score home loans really mean for the future of U.S. real estate, why these policies are suddenly appearing, who benefits the most, and why some experts believe this could completely reshape home prices in America over the next decade. And trust me, by the end of this video, you may look at the housing market very differently than before. Because what's happening right now isn't normal, and it could affect buyers, renters, investors, and homeowners across the entire country. For decades, the standard American mortgage was simple, a 30-year fixed loan. That became the backbone of the U.S. housing market. Most families planned their financial lives around it. But today, something has changed. Home prices exploded after 2020. Mortgage rates surged, property taxes climbed, insurance costs skyrocketed in many states. Suddenly, millions of middle-class Americans could no longer afford the average home payment. In many cities, even people earning six figures are struggling to buy starter homes. Think about that for a second. A generation ago, average workers could often buy homes in decent neighborhoods with stable incomes. Now, many young Americans can barely qualify for tiny apartments, let alone houses. So lenders and housing officials are trying to solve one massive problem: affordability. And that's where 50-year mortgages enter the conversation. The idea is simple. If monthly payments are too high, extend the loan longer and longer until buyers can finally afford the payment. A 50-year loan dramatically lowers monthly payments compared to a 30-year mortgage. On paper, that sounds amazing. Lower payment equals more affordable housing, right? Well, not exactly. Here's the catch nobody talks about. While the monthly payment becomes smaller, the total amount of interest paid over time becomes absolutely enormous. In some cases, homeowners could end up paying 2 or even 3 times the original home price by the end of the loan. Imagine buying a house at age 30 and still making payments when you're 80. That's the reality of a 50-year mortgage. Instead of homes becoming cheaper, the system simply stretches debt over a longer period. And that's a dangerous sign, because it often means prices have risen beyond what normal incomes can support. Historically, when markets become too expensive, there are only a few ways to restore affordability. Prices fall, incomes rise significantly, or lenders loosen the rules. Right now, America seems to be choosing the third option. And it's not just loan length changing. Another major shift is happening: no credit score mortgages. Traditionally, lenders relied heavily on credit scores to determine who qualified for a home loan. A strong credit score showed financial reliability. A weak score often meant higher risk. But millions of Americans either have low credit scores or no traditional credit history at all. Some younger people avoid credit cards completely. Others pay rent and bills on time but never build formal credit profiles. So new lending programs are starting to look beyond traditional scores. Instead of focusing only on FICO numbers, some lenders are considering rent history, utility payments, bank account activity, and other financial behaviors. Supporters argue this makes homeownership more inclusive, and honestly, for some responsible renters, that may be true. But critics worry this could also introduce more risk into the housing market. Because whenever lending standards become easier during periods of high prices, history starts flashing warning signs. Many people instantly remember the 2008 housing crash. Back then, banks approved huge numbers of risky mortgages with low verification and loose requirements.
Home prices skyrocketed temporarily because easy money flooded the market. But when borrowers started defaulting, the entire system cracked. Now, to be clear, today's situation is different in many ways. Lending rules are still stricter than they were before 2008. Most homeowners today have stronger equity positions. Banks are generally more regulated, but the similarities still make investors nervous. When housing becomes so expensive that society needs ultra-long loans and easier qualification standards just to keep demand alive, it suggests the market may be fundamentally unhealthy. And here's the part many people overlook. These policies can actually push home prices even higher in the short term. Why? Because lowering monthly payments allows buyers to borrow larger amounts. If thousands of people suddenly qualify for bigger loans, sellers often raise prices accordingly. So instead of solving affordability, the market adapts by becoming even more expensive. We've already seen versions of this happen with low interest rates over the past decade. Cheap borrowing fueled massive home price growth across America. During the pandemic housing boom, people focused mainly on monthly payments rather than total prices. As rates dropped, people borrowed more aggressively, bidding wars exploded, and prices surged to historic levels. Now, rates are much higher, but the affordability crisis remains. So instead of lowering rates, the industry may be experimenting with longer loans and softer qualification systems. But this creates another huge issue: debt dependency. Americans are already carrying enormous levels of debt from student loans, car payments, credit cards, and rising living expenses. Adding 50 years of mortgage debt on top of that could trap families financially for most of their lives. Imagine trying to retire while still owing hundreds of thousands on your home. That changes the entire meaning of ownership. For many people, homes may slowly transform from wealth-building assets into lifelong subscription payments to the banking system. And yet, despite all these risks, there's another side to this story that deserves attention. America still faces a severe housing shortage in many regions. Millions of homes were underbuilt for years after the 2008 crash. Construction costs rose sharply, zoning restrictions limited new supply, population growth continued. All of this helped create today's inventory crisis. So some experts argue that without creative financing options, homeownership could disappear entirely for younger generations in expensive cities. From that perspective, 50-year loans and alternative credit evaluations are desperate attempts to keep the middle class in the housing market at all. And honestly, that's what makes this issue so complicated. There are no easy answers. If lending standards stay strict, millions remain locked out of ownership. If standards loosen too much, prices could inflate further and financial risks could grow. Policymakers are essentially walking a tightrope between affordability and stability. Meanwhile, investors are watching closely. Some believe these changes will support home prices for years because more buyers will remain qualified. Others think this is simply delaying an inevitable correction. If unemployment rises or the economy weakens significantly, even smaller payments may not save over-leveraged borrowers. And if enough people struggle financially at the same time, housing demand could weaken fast. Another important factor is demographics. Younger Americans are approaching homeownership differently than previous generations. Many are delaying marriage, moving more often, or prioritizing flexibility over permanent ownership. Some are becoming skeptical of taking on massive debt for decades. Others feel forced into renting indefinitely because buying seems impossible. This generational shift could reshape demand patterns across the market. In some areas, especially expensive coastal cities, homeownership rates among younger buyers have already fallen sharply. Meanwhile, institutional investors and large corporations continue to purchase properties across the country, competing directly with ordinary families. That has created frustration among many Americans who feel like the housing market increasingly favors corporations over individuals. So when people hear about 50-year loans, some see opportunity, but others see desperation. They wonder if the market is being artificially stretched beyond sustainable limits. And honestly, both perspectives may contain some truth, because underneath all these headlines lies one simple reality. American housing has become extraordinarily expensive relative to incomes. That's the core problem everything else revolves around. Longer loans and alternative credit systems don't magically reduce prices. They mainly change how debt is structured. The real question is whether incomes can eventually catch up, whether supply can increase enough to stabilize prices, or if the market ultimately needs a major reset. Nobody knows for sure, but one thing is clear. The rules of the housing market are changing right in front of us. The traditional path to homeownership that previous generations relied on is evolving rapidly, and the decisions being made today could shape the financial lives of millions of Americans for decades to come. So if you're planning to buy a home, invest in real estate, or even just understand where the economy may be headed, pay very close attention to these trends, because 50-year mortgages